Our question of the day, is the shopping cart half full or half empty? And what happens if all of the Treasury curve stays above 4%, the Fed keeps hiking? We're going to ask Anastasia Amoroso, iCapital Chief Investment Strategist. Anastasia, you can answer that question from, say, a market retail stock point of view and then an eco point of view.
I'll answer it from the economic point of view, and I do think that the cart is half full, Alex. And the reason I say that, looking at the latest retail sales numbers, for example, we had some blowout numbers in some particular categories. If you look at restaurants, if you look at leisure, and if you look at travel, if you look at autos, those are all the categories that are doing really well. What's probably not doing well is anything that's been tied to the pandemic home improvement trend, and maybe just your basic, day-to-day shopping. So, but for the other way to think about this, the consumer is able to stomach this 5% rates economy. And there's a few reasons for that. First of all, you look at the unemployment rate at 3.4%. Consumers are employed, and they're more gainfully employed potentially as they were last year. Wages are still rising at 4.6%. So you've got jobs, you've got wages, and then guess what? You've got a lot more household net worth that has been created over the last 14 years. And sure, we gave a little bit of that back, some of it back, I should say, last year. But if you look at U.S. household net worth, it is still a multiple, a factor of what it was before the pandemic or back in, during the financial crisis. And then cash. There's $17 trillion of cash on household balance sheets. And guess what? That cash is not yielding zero now. It's yielding close to 5%. So you put all those things together, and I do think that consumers do have the discretionary spending power, and it might actually improve a little bit this year as inflation comes down, but wage growth still remains sticky.
There is an argument that says, Anastasia, that as rates go higher, the consumer spends more because, as you say, the cash that they have on hand is getting a better yield. Is that really the case? What yield do you think the Fed has to deliver here will break the consumer?
Yeah, I don't think it's 5%, Guy, because, if you look at 5%, if you look at the core PCE inflation, we're just looking at real rates still being right around zero. So that is not enough to sort of choke off the growth in the economy. I do think we have to start talking about 6.5% rates until you really get into this restrictive territory that might dent the consumer and might dent the corporates. And of course, we're not there yet. And I think at some point, the Fed will likely have a rethink of what is the right level of restrictive policy. I don't think that point is imminent. I don't think it's in March, but especially as we get into the back half of the year, and I think it's likely to become evident that inflation is not yet on track to 2%, and in fact, it might start to pick back up in the second half of the year. I think that's when the Fed will kind of wake up to this and say 6.5% rate is probably the next destination, but that's probably not the imminent stop right now.